The broadcast is now starting. All attendees are in listen-only mode.
Okay. Good morning, everyone. I'd like to welcome you to the OptionsCity webinar series. Our topic for today is going to be managing volatility in a dynamic market. My name is Jim Abbott, and I'm with sales here at OptionsCity. We have a guest speaker today. Dave Hrencecin is a Director of Quantitative Analytics. Hi, and welcome. And what we're going to do today is we're just going to give you a brief tutorial on a volatility path, why it's important in our trading, and how it affects our Greeks and our risk. I hope it's educational for you, and hopefully we can teach you a thing or two about trading, and hopefully show you how OptionsCity can enhance your trading and want you to learn more about our software. Quick overview about OptionsCity. We were founded in 2006. We're based here in Chicago, Illinois. We are an end-to-end solution for option pricing and market making. Some of our better features are our electronic eye, auto hedging, and integrated risk management. We have the ability to quote, mass quote, and do all of your options needs. We are certified independent software provider on all major exchanges in the continental U.S. and internationally too. So with that brief introduction, I'd like to start today with our topic, managing volatility in a dynamic market.
All right. I'll take over for a bit. This is Dave Hrencecin again. What I would like to try and cover for you is basics of what a volatility path is and what, how you would understand it and how it would affect things. So we're basically going to start by talking about the relationship between vol and spot, and then we'll talk about how that impacts your pricing and hedging, and then I'll finish with the adjustments to the Greeks so that you have a good understanding of what to expect when you use the volatility path to capture this dynamic in OptionsCity Metro. So we'll continue. First on with the vol versus spot relationship. All right. So basically what we're talking about is the effect of volatility on the underlying. When the underlying prices move, generally we see that prices cause volatility to change as well. So we've got a relationship between the at-the-money volatility and the underlying price. For example, in equity options, we generally see when prices rally, volatility comes down. When prices tank, then things get more volatile. And then there are other markets, for example, in the grains options volatility goes in the opposite direction. When market prices decrease, then the volatility decreases as well. So here's an example so that you can see what we're talking about. I've got 2.5 years of data comparing the VIX, which is an indicator of volatility for the S&P 500, as it compares to prices in the S&P 500 as represented by the SPX. So what we can see in here is when prices are high in the 1,300, 1,200 range, we've got volatilities that are fairly low in the 20% Black-Scholes vol range. And on the other hand, when we had prices lower in the earlier part of this history, we had volatilities that were in the 50% range. Now, one more thing that I might point out here is that although we can see there is this general trend, there are pockets of activity where it doesn't quite live on the trend. So let's kind of narrow in and look at some shorter-term trending behavior that occurred. So basically, we'll see this decreasing on a quarterly by quarterly basis. So if we look at the, say, best fit of the points for each quarter from 2009 to present, we see that pretty much this trend is downward very consistently. And in some cases, like, for example, in 2010, the first quarter, the fit was very tight. In general, we can look at some shorter-term time frames and see that this trend is pretty good. And the point is that it's consistent within a band of time. So let's look at what that means to our pricing and hedging. So what we do when we calculate hedge ratios, we generally, with the Black-Scholes model, for example, will make assumptions that the volatility remains constant as the underlying changes. So what we've got here is a payout diagram of what the option would be worth for a 100 strike straddle. And I've got the underlying changing from, say, 60 up to 140, and the actual theoretical value of that straddle as that price changes, keeping in mind the strike is fixed. This is based off of an assumption that the price, or that the volatility is constant. So now, what happens is when we look at this assumption, we can calculate the delta, and that's the slope of this line here. And that would be an indication of how we would hedge. Now let's suppose that we have an increase in the underlying, and then that leads to lower volatility in general. So what will happen? Well, call prices, they're going to grow less than expected. So we'll see some downward pressure on the upper side of the underlying in this plot. And also, put prices, they'll decay less than expected. And so you see this twisting of the plot. What ends up happening is we end up with a delta that's higher than what was implied previously. And that impacts things dramatically. In this case, we started out with a delta that was positive, and it turns out that when you apply this dynamic, this change in volatility, you actually end up with what you should have been hedging with is a negative delta. So what we need to do is adjust our deltas to account for this trend. So if we have a downward trend, like with the S&Ps, then the deltas are actually going to be too big, and we need to adjust these deltas to account for this trend so that the hedge ratios will be accurate. So how do we do that? We'll just do a brief overview of the calculus involved. Not to get too scary, we'll just think of it in sort of big terms and give you the basic idea so that you know what to expect when you see it in the system. So let's start with basic option pricing formula. This could be the Black-Scholes model or Whaley or whatever it is that you use. We have our standard inputs of the underlying, the strike, volatility, and so on. And when we do this with the Black model, for example, it's typical we'll take volatility in terms of a skew as a function of strike. Different strikes, we use different vols. So why not let's view this as volatility as a function of spot instead? So when we do that, right here, we just take the original formula and stick in a new function and just treat this thing as a black box. So we can use the model and forget about how it was derived and just change the rules. But then if we're going to do this, then we need to actually also make changes to the original Greek calculations. And it's basically by applying, if you remember from back in the days of school, the multivariable calculus chain rule. Now, let's not get too scared about this. Basically, we're just taking a derivative, which is calculating the rate of change as the underlying changes. And in order to get that rate of change, we have to look at all of the sensitivities that depend on the underlying. So we have to calculate a delta, which is the change in the first slot here with this spot. And then we also have to add to it a vega, because that's how the underlying affects the change in the third slot here, or in the vol slot. But the issue is that this volatility sensitivity is in a different set of units. It's in a change of the price as the volatility changes. So essentially, the chain rule has us apply a unit conversion, which is the rate of change of the volatility as the underlying changes. And all that gives us in the end is this correction, delta plus vega times the slope of the volatility, or the rate of change of volatility. And if you recall, when we had a delta and then we had a downward sloping trend in volatility, then that would mean that our original delta was too big. Vega is typically positive when you're talking about just a call or a put. And so this vol slope being negative, we'll end up having a subtraction from the original delta, and that's what we'll end up with, an adjusted delta that's consistent with the behavior that we observed earlier. Now, as with the calculation of delta, basically we need to adjust every single Greek that depends on the underlying price. So we have delta that is adjusted. We have a gamma that's adjusted. Zeta, which also depends on the underlying. That's the rate of change, for example, of delta as you change vol, or the rate of change of vega as you change the underlying, and also epsilon. So now, what's exactly going on in Metro? And we'll talk more, Jim will kind of show you how it's actually set up, is that you'd set up your curve, your skew, and then you'd also set up a volatility path, which is this orange line here. And that shows you where the at-the-money vol is going to be moving as the underlying changes. So let's suppose, for example, that the underlying goes down to 95. Then this entire skew is going to ride up to the left, up that volatility path. And then we come back to the underlying spot of 100, and then the skew moves back. And then further on, we rally further, and volatility comes down. This is exactly the effect that we are replicating in OptionsCity Metro. Now I'll pass it back to Jim, and he'll show you the how you would use it in Metro.
Dave, thanks so much for that. You know, when I was trading on the floor, I always knew intuitively that as the market would rally, I needed to stay long because I knew those deltas, out-of-the-money deltas, weren't acting correctly, and they weren't showing me my true position. And so I just knew to stay long. I didn't know really how to account for that. And seeing something like this volatility path that you just explained kind of explains that to me. But still, it's, you know, how do I use that in my trading? You know, obviously I don't have the multivariable calculus chain rule in my head. So, you know, fortunately for us, there's something like OptionsCity Metro that helps us do this, not only in a calculating way, but a visual way. And that's one of the strong points of our software is it presents stuff in a visual way for a trader to really see what's happening. So let's quickly go through. I want to take you through a couple steps here in our software. What I've got shown on the screen here is our model setting form. And this was the skew path that David talked about. Over here is our data input, which we can look at. And I'm going to just zoom in on that a little bit and quickly go over what this is. Basically what we have here is our at-the-money strike, 1336 in the E-minis right now. We have our at-the-money vol, and what we're showing here from our data input, we're showing our put curve, our put slope, our call curve, our call slope, and then we have wings that we've set up here that are accounting for those far out of the money, so we're not getting calls.
You need to close the poll.
Yeah.
Oh, sorry about that. Okay.
That blocked on the other poll open.
It blocks out our thing. Okay. We may just have to not use that. Okay. Okay, and these are just your other inputs, your data inputs. Again, and then going back, this is showing it graphically. This is showing, this is our at the money, these are our put our put curve and slope, and over here you see where our wings, where when the E-minis get above 1800 or below 800, I don't want to show any false deltas on those far out of the money options. Going on and back to more what Dave was talking about, our volatility path configuration. Again, highlighting here in the orange line is representing our volatility path. Again, our data points are over here to the left. What we've done to configure this graphically is we picked our midpoint, which is our at the money. Our left point is 25% down move. Our right point is 25% down move, 25% up move. And then correspondingly on our graph, we're showing our midpoint here, which is our at the money, down 25%, up 25%. And this shows us our path graphically. Incorporate these all together. We now have our volatility path. We have our volatility path. We have our skew. And now our skew is going to follow up and down this vol path, changing all of our Greeks in real time to give you a truer delta, truer gamma, truer vega as you're trading throughout the day, updating again to give you a true sense of the market to further enhance your trading. To take this a step further, another highlight is in our risk report. By using these truer Greeks, as Dave alluded to, by utilizing the vol path, you are now on your risk report up and down in each instance getting a much truer sense of your Greeks, which are reflected in real time at OptionsCity in our risk report. So you're not having to compensate like we did on the fly in the days. This is giving you a much truer sense. If you have that truer sense of your true Greeks, then you're going to have more confidence. You can focus more on your trading and not so much worrying about whether or not your model is correct. To quickly summarize, using this volatility path reflects truer Greeks. It's going to give you more accurate risk management, and ultimately it's going to lead to more effective trading decisions. This is just a tip of the iceberg of what we at OptionsCity have to offer traders as a whole. I hope that we've given you a little bit of a primer today. Hopefully you've learned a little bit more about a vol path and some skew than you did when you came in today. I'd like to thank you for attending today. We would love to further this discussion and show you all of the bells and whistles that we have to offer, our comprehensive end-to-end solutions at OptionsCity. Please feel free to contact me for any questions or to set up a demo. We can do it. You can come by our office and see it, or we can do it remotely, whatever's convenient for you. At this point, I would like to open up for questions for Dave or myself from anybody in the audience. So at this point, I'm going to see what we have questions. I know what I'm asking for. We have our first question, and it says, how long does it take to implement OptionsCity? I would say we would probably, from start to finish, usually we like to give people about a 5-week lead time. That's probably going to incorporate in, you're going to come in for a demo or two. We can certainly do it faster if need be. 3 weeks is fast as 5 weeks is about normal. The way that we would generally do the process is you would come in for a couple of demos. We would show you the software. You would see how great it is, and you'd want to sign a contract. I'll quickly walk you through the process then. What we do then is we then take over. We find out who your clearing firm is, what products you use. We help with all connectivity, your server issues with the exchange. We then we like to go through comprehensive training with you, so we're not just handing you over the software and you're not utilizing all that we have to offer. We have trainers that come in to make sure just to navigate around, set your parameters. Another trainer who specifically sits you down to do basically what we went through today, to set your vol paths, your skews, stuff, different things like that, which models you're going to be using corresponding to what you're going to be trading. Then we do a couple of dry runs, and after we get your I-links for the exchanges and your clearing firm, you're good to go. I hope that answers your question. Next question, anyone? Do you have so many traders because it's impossible to implement? That question means, Steve. Dave, do you have anything further to add on the volatility path?
I don't see any questions. So.
Okay, if that's it, look, I really appreciate you guys coming in today. I know that it's in the middle of the trading day, and you know, even though it is in the middle of the day, we do appreciate it. We appreciate your support, and for you that are current clients, thank you for your continued trust in us, and for prospects or people that are just looking, we again welcome the opportunity to talk to you further. Thank you for coming in, and have a great afternoon. Good luck trading.